Good afternoon, everyone. Thank you for joining us here at Navy Mutual Education. You have probably heard of us before. Uh, we've been around since 1879, one of the oldest federally recognized veteran service organizations in the country, and also a fantastic way for service members to get life insurance for their family. What you might not know is that we have a whole education and veteran services side of the house where our mission is making sure that service members get the benefits for which they are entitled to. And we also provide financial education. So, my name's Heather Walrath. I am an accredited financial counselor with Navy Mutual. I have been working as a financial counselor within the DoD community for about 14 years. And honestly, more important than that, I have been a military spouse for 25 years. So, my husband and I have bought a few houses during our military journey. So, today we're just going to talk a little bit about navigating the home buying process and using that VA loan entitlement that service members and in some cases spouses are eligible for. So, let's jump in today. So just keep in mind, this is a basic guide. I really encourage you before you take the plunge into any type of home buying to talk to a financial planner, a financial advisor, to understand how this might affect your personal financial situation. So, first of all, let's start out our conversation today discussing whether or not home buying is actually right for you, right? And there are so many different pieces to this puzzle. So, pros and cons. Well, the home may not increase in value, right? Historically, real estate has always been known as to be one of the better investments, but we've all heard the stories of properties that actually lose value as well. So when you're the owner of the home, you have to pay all the maintenance costs. There's no calling the landlord to get them to fix that leaky faucet or when the AC goes out. One casualty, if you'll say, when your house does gain value, is your tax rate also increases, right? So we pay taxes based on the value of our house. And as the value of that house increases, so does the taxes, even though we may not actually be able to access the equity in the house at that time, right? I also caution everyone who is thinking of buying a home to be prepared to be a landlord, particularly with our active duty folks. But, regardless, life happens, and you may find that you need to leave the area, you need to sell the property, and maybe you don't have a buyer. Maybe the time is not right. You have to pay that mortgage, regardless of whether the fact you have a renter. So, some things to consider, right? You also need more money up front because there's a lots of costs associated with buying a home, even if you do use a VA loan. And then don't forget, it might limit other investments. Right? If you're putting money into your home, if you're paying those closing costs, funding fees for your loans or things like that, that's taking away from other money you might be saving up for other purposes. Pros, again, hopefully that home does build value, right? You're no longer throwing your rent away. You can walk away with some equity to it. You can deduct the interest from your mortgage on your taxes if you itemize. Now, the standard deductions have gone up, so it's getting harder and harder for people to itemize these days. But that's definitely an option if you do itemize. And you might have more choices, right? There might be more homes on the market available to buy than to rent. Um, and you've got the ability to customize it however you want. Paint those walls purple, right? So some things to consider. You know, if you're still active duty, consider your time on the location. There is no guarantee on how long you will be there, right? I've heard the stories before. Hey, this is a controlled tour, guaranteed, and then the needs of the military change, right? So just know that you have to be responsible for that regardless. Now, what exactly is the VA home loan benefit? Well, first of all, it's not the VA giving you a loan, okay? A private lender actually provides the loan for you to buy the house, but the VA does guarantee a portion of it, which means in most cases you don't need to have a down payment, right? Also, you won't have to pay any mortgage insurance. So typically, if you can't put at least 20% down on the home, the lender's going to require something called private mortgage insurance that actually protects the lender, not you, but you have to pay for it. So that's not part of this if you use the VA loan. It's also a usable benefit. You can use it more than once, and we'll talk about that. There is a funding fee associated with it that helps to fund the program. Um, but that is waiverable if you are receiving disability pay. Also, there's some minimum property requirements that the property has to have for you to use a VA loan when purchasing it. And if you do have assistance making your mortgage payments, there's assistance that comes from the VA. Excuse me, if you have difficulty making that payment, there's assistance from the VA that can help you with that. And one thing that's really unique that we'll talk about a little bit later today is that the loan can be assumed by another qualified lender. And this is kind of important today because, a year or so ago, mortgage rates are really low, under 3%. They've gone up quite a bit. So that could be really an advantage if you're looking to buy a home now, if you can assume a loan from a buyer that previously locked in, that 2% rate that we had a couple of years ago. So there are actually 4 types of VA loans. What most people are familiar with is the purchase loan, right? That's what most people will use. There is a program for Native American veterans, and in that particular program, the money does actually come from the VA. The VA is providing the loan. But there's also interest rate loan reductions and cash out refinance programs as well. Now, is the VA loan the best loan to use? I don't know, right? It really depends on the situation, and you need to kind of weigh the pros and cons of that. So, benefits include the fact that there's little to no down payment required, no mortgage insurance, typically lower closing costs for the buyer, and easier qualifications. Typically, a lender will let you qualify with a lower credit score, possibly some lower income requirements than you might need from a conventional loan. However, keep in mind that every lender who does a VA loan does have their own loan processing requirements, right? So you might find differences amongst lenders when you're out there, checking for different rates. And there's no pre-repayment or pre no repayment penalty. So if you pay early, there's not a penalty for that. Um, so that's important as well. Drawbacks, you do have to pay that funding fee unless you have that disability rating. Also, if you're not putting down a down payment, you don't have any equity in your home, right? So that could be a consideration. And the VA does have specific specific requirements for that home that it has to pass before you can use a loan to purchase the property. So it can be kind of tricky if you're looking to purchase a fixer upper or something that needs some work. And some sellers dislike VA financing because the home has to have certain requirements. Okay, and we'll talk a little bit more about that. And then keep in mind again, you still have to meet all of those lender qualifications. So the fact that you have a VA loan entitlement does not mean that you automatically are going to qualify for the mortgage. Okay, so that's an important consideration. The other thing that you need to understand about a VA loan is it was designed to be your primary residence. This whole program came about after World War II to help service members become homeowners, right? So it's not designed to buy your vacation home. Okay. So it has to be purchased as a primary residence. You typically have to move in within 60 days of closing on the home. You can usually work some exceptions into that if, possibly you're deployed or there's some work going on to the property before you can move in. There's no set required time to stay in the home by law, but most of the loan paperwork is going to stipulate at least 12 months. Okay. Now, let's say that for active duty folks, the member is deployed, they get the loan, but the spouse is going to immediately occupy that. That would satisfy the requirement. It's a little trickier if you're putting a child in there. Like, let's say you have a child at college and you're going to buy a property for that child to live in. That typically is not going to qualify unless it has specific certification from the lender. So just kind of keep that in mind. So now, once you live in the home, for that 12 months, if you move and you rent it out, that's okay. But it's supposed to initially be for that primary residence. So, who is eligible for a VA loan? Pretty wide parameters on that. You can go to the VA website that's listed there to get the specifics. But, basically, if you're a veteran, as long as you serve 24 months, that's typically the standard. There's some unique situations, right? If it's less than that. If you're on active duty now, you only have to have served 90 continuous days, and you would be eligible to use the VA loan program. Guard reserves, a little bit different. If you were activated on Title 10 orders, you serve 90 days of active duty service, that qualifies you to use the loan. Typical guard reserves, it's usually 6 credible years, and then you're going to be eligible for this benefit. But again, you check the VA website, it's very up to date, has all the specifics of your particular situation. Now, in order to use this program, you do have to give the lender a certificate of eligibility that shows that you qualify. Lenders can typically pull this themselves, but it does take them a little bit longer, right? Government bureaucracy, a little bit more paperwork for you to fill out, or you can just pull it directly through eBenefits. And this is the eBenefits site. So you can go there, you can calculate your loan benefit and entitlement and get that certificate of eligibility. So you just print that out, take it to your lender, and you're good to go. So there was something that was passed in 2019 called the Blue Water Navy Vietnam Veterans Act, and it had a lot of really great things in it for our veterans. But one thing that was kind of buried in there was that it did increase the loan entitlement. So basically, you don't have to have a limit on that initial loan. There's no limit for that. You can use it subsequently if you already have a loan, but then there's some limits based on where you're going to buy that property. So that was really a change. There used to be limits. Now, of course, just because the government says they will back this loan, or just because your lender says they will give you the loan doesn't necessarily mean you should, right? I get that question a lot. Hey, they said I could qualify for $500,000. Should I spend that much? Well, that's up to you, right? Because what else are you not going to be able to spend that money on? But this Veterans Act of 2019 did increase those limits. So, what do I mean by entitlement, right? Well, you have a full retirement, a full entitlement. It it means that you have no loan, no limit on that loan. Okay, and that happens if you've never used the loan. So if this is your first time you're using this entitlement, there is no limit. Or if you paid off the loan in full and you sold the property, that frees it up again. You've got the full entitlement. Also, if you use the program but maybe had a foreclosure, a short sale, but you did repay the VA in full for their guarantee, again, they restore your full entitlement. Okay. Now, let's say you already have a home. Um, you moved, you rented it out, and now you want to buy another home. Okay. Well, that is where you would want to see what your remaining entitlement would be. And this applies if you have an active loan, right, on that rental property, or maybe you paid the loan back in full, but you still own the home. Okay. So owning that home, even, if you paid that loan off, yes, that still locks you in. You only have a remaining entitlement. Okay. If you refinanced into a non-VA loan, that gives you a remaining entitlement. If you have any loan balances because you had a foreclosure or short sale and didn't pay the BVA back in full, these are all cases where you would have a remaining entitlement as well. Now, the limit for that remaining entitlement is really going to depend on the county loan limit where you're going to purchase this other house. Okay. So that's significant as well. So we'll talk about that. So, where do you find out what these loan limits are for these remaining entitlements? Well, you can go right here to the FHFA Gov site, the housing site, and that's where all of the loan limits are going to be. Okay, so you click here, and you can search by county. Okay, so here are some counties in Virginia. So you see if you want to get something in Amelia County, we scroll over. The limit on a one-unit dwelling is 647,000. Okay, so that's the county limit. So you could use a remaining entitlement on anything that would be more than that. Okay, so that's where you can go to kind of look up to see what the limits are in the county. Now, how does this actually apply? Well, let's break it down a little bit, okay? So, here's an example of the full entitlement. So, the loan amount was 1.2 million. Gulp, right? That's a big loan, right? So, in that case, remember there's no loan limit. The VA is going to guarantee $300,000 of that. All right. So you don't have to have a down payment because that's guaranteed by the VA. Okay. So that's the case of a full entitlement. Now let's look at what happens with a partial entitlement. So in this case, a borrower used $70,000 of their entitlement on a prior VA home loan. Okay, and they still have that home loan, so it hasn't been restored. Now the borrower wants to purchase another home with a loan of $200,000. Okay, now the county limit where they're wanting to buy a new home is 600,000. So we're good there, right? Because their loan limit is below that. So the maximum amount of guarantee for this remaining entitlement is going to be calculated one of two ways, and then they give you the lesser amount. Okay, so it could be calculated by subtracting your remaining entitlement. Okay, so first home, you had $70,000 of entitlement, right? So the county loan limit is $600,000. 25% of that is 150,000, right? That's what would be guaranteed by the VA. You subtract the entitlement you already used, remaining entitlement is $80,000. Okay, that's one way to calculate. The other one is you take the loan amount, 200,000, times 25%. That's the most that the VA will guarantee. In this calculation, comes up with 50,000. So it's less, right? But that's the amount the VA is going to go with. Okay. So basically, you don't have to put down the down payment. The VA will guarantee up to $50,000 on this next property. Okay. But again, just because you can doesn't mean you should, right? You need to really think about, how much you can truly afford. Don't let the bank decide, right, what's right for you. Just because you can qualify, they don't care if you're going to have to eat ramen noodles or, you know, forego any vacations or anything to pay for this house, right? So you need to consider that. Now, that might have been a little complicated, right? That example that I gave you. So there's a calculator for that, right? You don't even have to do all the calculations. You can just go to the VA website and pull up the calculator. So here's another example for Fairfax. Okay, in Fairfax, the county loan limit is $970,800. Okay, previously, someone had an entitlement of $70,000. They want a new loan for $800,000. Using the calculator, we find that they can be guaranteed $172,700 by the VA. Now, look at that though. That is not quite that 25% that a lender might be looking for, right? So, what happens here? Well, if the lender is going to give you the VA loan, they might require you to bring additional money to the table to get that down payment guarantee up to 25%. Okay, so you might have to bring the other 3.5% to the table in order to use that VA loan. Okay, so that's a great tool that can help you identify if you have any remaining entitlement. Now, I mentioned that there's a funding fee, right? This is the way that they do fund the program for other borrowers. This is a one time payment that can be added onto that VA loan. And the whole purpose is to help lower the cost for the taxpayer, right? To make this more of a self funded program so the taxpayer is not footing the bill. It can be included in the mortgage. Okay, so you don't have to have cash to pay the funding fee. You can include it in your mortgage. However, the downside of that is that you're then paying interest on it, right? Because it gets included in the balance of your mortgage, so you're having to pay for it. Now, you don't have to pay the funding fee if you receive VA disability compensation, or if you were eligible to receive, but maybe it's offset by DoD retirement. Okay, so if you're eligible to get it, it can be waived. Also, if you're a surviving spouse receiving DIC, that's dependent indemnity compensation, don't have to pay that funding fee. If you have a proposed memo rating before closing, that means that you've filed things with the VA. They've given you something that they proposed it will be, but it's not guaranteed before you close. That will help. And then Purple Heart recipients as well. Okay. So again, disadvantage of having that funding fee in the mortgage, well, you're paying more for it, right? With the interest. So how much is the funding fee? The first time that you're going to use it, it's going to be 2.3%. Okay. Now, that's if you don't have a down payment. So notice that if you do decide to use a down payment, that will reduce your funding fee. So sometimes people like to do that, right? Maybe they get a good rate with the VA loan. Maybe that's better than the conventional loan. But they want to put some money down so that they have some equity in the house. And of course, the less you finance, the less interest you're going to pay over time. Right. So if you use the VA loan, you can put a down payment on, and that will reduce your funding fee. After the first use, right? We talked about remaining entitlements and things like that, or if you get your loan back. The second time you use it, the funding fee is higher, 3.6%. So do keep that in mind. It's still reduced if you have a down payment, but the fee is going to be higher the second go around that you use it. And then there's some other types of funding fees as well. If you do a cash out refinancing loan, that's 3.6%. Um, an interest rate reduction, that's half a percent. And then there's some other things as well. There's also a fee if you assume a loan, but it's about half a percent. So depending on the type of loan, the funding fees might vary a little bit. Now, when you use a VA loan, you're also required to have a VA appraisal. Now, this is not something that you would do. This is something that is going to be ordered by the lender. Okay. And they're going to request a VA approved appraisal to provide their opinion of the value of the home because the VA is not going to give you a loan for more than the home is worth. Okay. So this appraisal is required. All right. You can't get out of it. And this is very different from a home inspection. Now, do you need both? Yes, because they serve different purposes, right? The appraisal, provides an opinion of whether or not the value of the home meets, what the buyer is asking, meets that loan requirement. And the appraiser will also look to make sure that there's minimum property requirements. Things like handrails have to be installed, decks have to be up to code, there has to be heating and air conditioning and things like that. So those are the things that the inspector is going to look for. Um, or the appraiser is going to look for. Now, on the other hand, you have an inspector. Now, this is a person that you, as the buyer, might choose to hire to kind of take a look at things, right? To make sure that you know what you're getting. So they will come and maybe inspect the electrical of the home, maybe give an overview of the plumbing, see what the condition of the roof is, right? So that's really important. Check out the AC and the furnace, make sure everything is in working order. That's protecting you from buying a lemon house, right? An inspector might cost $500 out of your pocket, but in my opinion, it's better to spend that $500 now than get the house without an inspection and walk into a $20,000 foundation problem, right? But the inspector and the appraisal would be two different people. Okay. Now, what if that appraisal comes in low? Right? What if, you're going to offer $200,000 on the house and the appraiser says, "No, I think it's really worth 180." Well, you do have some options. You can request a reconsideration of value. So if you feel, that it's too low, ask your lender or your real estate agent like to pull other sales data, from the houses. Maybe there's houses a block over just like yours that did just sell for 200,000. Right. Or maybe there's other things that have sold in the neighborhood that could potentially give you reason to increase the value. Right. They're building $1 million house two blocks away. Right. So you can ask for that reconsideration of value. You could also go back and try to renegotiate the sales price with the seller. Say, "Hey, the appraiser says it's only worth 180. That's all I'm going to be able to pay." That is one reason that sellers don't really sometimes like those VA loans, though, because you can't get a loan for more than it appraises. And in hot markets that we had the past couple of years, people were paying $100,000 over the asking price to secure these properties, right? Um, you also have the option to bring cash to the table. So maybe you still really want this house. The VA is only going to give you 180, so you bring that $20,000 to the table so the seller gets their whole 200. Okay. You also have the option in a VA offer to back out. Okay. When you put in an offer for a home, you do have to list the type of financing. And if it's a VA loan, by law, if it does not appraise, you have the ability to get out the contract to get all of your deposit money back. And so you have that protection. Okay. Another thing that you might want to consider if it's a new construction is a cost approach. Okay. And what that means is if it's new construction, like let's say it's a brand new neighborhood, there really aren't very many other comps around there. So you talk about how much it actually costs to build the house, right? And then they can come up with the appraisal from that. Okay. But again, because of these appraisal requirements, a seller might not like, a VA offer. If you're getting five offers and four of them are conventional loans and one is a VA, they might not look as favorably on that VA loan because there are these additional requirements for them, right? So another thing to consider. Now, I told you that the beauty of a VA loan, or one of the great things of a VA loan, is that you don't have to have that down payment, right? Um, 20%, that's a hefty amount of money, right? So that's one great thing that allows you access to homeownership without that down payment. However, there is something called closing. Okay, and there are fees attached to closing. And these costs are usually about 3 to 5% of the cost of the home. So it's for things like an application fee for the lender, the appraisal, you have to pay for that, the attorney's fees, who review all the documents, credit reports, title insurance, all kinds of things. Okay. So that does have to be paid for. Okay. And typically cannot be rolled into the loan. So that's why it's important to understand that yes, you do still have to have cash to buy a home with a VA loan entitlement. Now, VA loans also have stipulations about who pays the closing costs. So sometimes, depending how the market is, the buyer seller might negotiate who's going to pay these closing costs, right? If it's a seller's market, typically the buyer is going to pay everything. The seller's not going to offer any concessions. In a buyer's market, might be the opposite, right? The buyer might insist, hey, you're going to pay for part of my closing costs, right? But VA rules dictate who pays for some of these things. Okay, so the seller has to pay the real estate commission. Okay, so you can't have any clauses where the buyer is, going to pay their own real estate or anything like that. Seller also has to pay the brokerage fees and a termite report. That's another thing that's required. Got to have a termite report. They're usually not super expensive. But again, a homeowner or a seller, might balk at the fact that they got to give a termite report, right, for this home when the conventional loan isn't going to require that. There are some things that can be negotiated. These other things here on the slide, those are things that maybe you can work into the contract. Those are kind of up for grabs. But again, there are some requirements of some things that the seller has to do to close this deal. So, of course, there's calculators for that as well. This is a site that I found helpful that's in some other DoD curriculums out there. It's a website called Smart Assets. Can't vouch for everything that's on there, right? Because it's an independent site. We don't maintain any control over that. But it does have some very useful tools for calculating what these closing costs will be. So let's take a look at this example. This happens to be for a house in Fairfax, Virginia, that's $500,000 using a VA loan. Okay, so there's no down payment. And in that scenario, the closing costs are going to be almost $13,000, right? So you have a one-time closing cost, and those are those things like title insurance, inspection fees, application fees. It's about 8,700. And then there's something called escrow. Now, when you buy a home, you are, of course, going to have as your payment the principal of that loan and the interest every single month, right? You'll be making this payment for 15 years, 30 years, whatever the duration is of your mortgage. However, there's another component to your monthly payment in most cases. So the lender is going to require that you have homeowners insurance, right? And of course, you would want to anyway, right? Biggest purchase you're ever making, you want it insured. So typically, you're going to pay 1/12 of your homeowner's insurance with your mortgage payment every single month to make sure that that policy stays into effect. And what happens is it goes into something called an escrow with your mortgage company. Then, when the insurance bill is due, the mortgage company pays it directly to make sure that it gets paid. Same thing happens with your property insurance. Okay, you're going to pay 1/12 as you go throughout the year with your mortgage payment, and then the lender is going to pay the county when the taxes are due because they certainly don't want the taxes to not be paid and have there be a lien on the property, right? Because that's their collateral. So that's what is referenced here as escrow because you typically have to pay 1 years of insurance up front, 1 year of property taxes up front. Okay, so those are things also that are going to be included in the closing costs. So here's an example of what that monthly payment is going to be. Okay, so we've got the monthly payment, the principal and the interest, right, is 2,300, 20 or 2,800, 2,838, right? But again, you got to account for the property taxes and the homeowners. So those two things together are about 6,300. Right. So you divide that by 12, you add that on there, and that bumps your payment up to 3,363. Okay. So be careful when you're out there using those calculators like on real estate sites, Zillow, Realtor.com, and it'll say, what's your monthly mortgage payment going to be? They're usually only accounting for the principal and the interest. Okay, so in this case, if you went in thinking, that you were only going to pay 2,800, and then you close the deal and you get the paperwork and you get the first voucher to pay that mortgage, and it's 3,300, that's $500 more. Okay, so that's really important to account for the property taxes and the homeowner's insurance in that payment. Also, want to point out your mortgage payment is not going to stay the same in most cases. Well, what do I mean by that? Well, yes, the principal and the interest portion will stay the same, right? You're going to get this 15-page long document that shows every single payment, right? How it's broken down for the 30 years. That will stay the same. But hopefully, your house is going to grow in value, right? You'll get some equity. Well, as your house grows in value, your taxes are going to go up. Okay. And if your house is more valuable, it's going to cost more to insure that house. So your insurance is going to go up. So that 1/12 that's tacked on to that principal and interest is going to go up. Okay, so we've owned a house here in Northern Virginia for 2 years. The last 2 years, our mortgage payment has gone up because of the taxes and insurance. So something to consider, right? And I like to point that out because, sometimes I get people that are taking on a payment that is really close to their max, really tight, and then don't realize that it likely will increase as the value of the property grows, right? So just want you to be aware that that will probably happen. So, how do you make your VA loan more competitive, right? Talking about the reasons that a seller might not like that VA loan. Well, you can work with a specialized lender, right? Someone who is very familiar with VA loan processes, um, can help with that a little bit more. Also, you can make a down payment as part of your offer. That shows that you have cash available if the appraisal is lower than the asking price, right? The seller still knows they can get the money that they need because you've got that cash. And of course, just make a strong offer and give a higher deposit before closing. So there is something called earnest money. So when you make an offer on a property, you send in the contract. This is how much we're going to pay. We're going to be financed through VA loan, conventional loan, and we will make a down payment, deposit essentially, of usually 1%. Okay, so that's another thing you're going to need to have cash for. So if you're buying the house for 500,000, with your offer, you got to be prepared to give them a $5,000 check. Okay. Um, so the higher, that deposit, the more serious, the more likely possibly the lender would be to take it, right? Now there was a lot of buzz, this summer really about this whole thing, when the market was just insane. Luckily, it slowed down a little bit, but now interest rates are higher, right? So it's kind of a crazy time in the home buying world. But a lot of people were frustrated because their VA loan offers were not being accepted, right? And the reality is, in a survey from the National Association of Realtors in 2021, they found that 94% of agents said that sellers are more likely to accept an offer with conventional financing. So almost all, right? So it kind of puts our VA loans at an advantage. So they were requesting, some senators to improve the process to make it more competitive and to give veterans more negotiating power. So they sent the questions. Nothing has really come of that yet. But I want to point out that really and truly, the reason that there are these requirements, like the appraisal, that the house is livable, that it has certain standard things like, handrails, air conditioning, working heat, that is for your protection, right? To make sure that you're not buying a lemon out there, right? That's going to need all this work and just loses value out the door. So I do kind of see it both ways, personally. Yes, I want my VA loan to be considered by sellers, but I don't want to make a whole lot of concessions. I don't want there not to be an appraisal. I want my home to be valued, what I'm going to pay for it, and I want to make sure that it's in livable condition. Right. So you can kind of take it both ways. So we will see if anything comes from this, if there's any changes in the VA home loan program to help make it more competitive. So we'll just have to keep an eye out for that. But so far, nothing has gone through. Now, I mentioned at the beginning that one benefit of VA home loans is that they can be assumed. And the interesting thing is, it doesn't necessarily have to be by another eligible veteran, it could be by anyone. However, the VA does have to approve the assumption. Okay. The assumer also has to financially qualify, and there's approval from the lender required. Okay, so they're going to have to go through the same qualification process, probably that you did, right, to provide those documentations. And the important thing to understand is your legal liability for the debt of this home loan doesn't automatically just go away if you have someone assume the loan. You have to make sure that you ask and obtain something called a release of liability from the lender. All right. That's really important because without that release of liability, if that buyer who assumed the loan defaults on the loan, doesn't pay, you could still be held liable for that. Okay. So that's really important. Also, if you don't get that release, that entitlement that you used to purchase the home is going to remain tied up in that home, right? So if you go to buy another one, you're only going to have a remaining entitlement. You won't have that full entitlement because your VA loan is still out there. Okay. And again, if you don't get that release, you could lose your future benefits if that person who assumes it defaults on the loan. Right. So just be careful. It could be a really great deal if you're looking to buy. Interest rates are 6% now, and you can assume a loan at 2.5. But just make sure everything is processed correctly, especially if you are the seller, right? And you're going to let someone assume that loan. Also, another thing to point out is the loan does have to be current. So if you come across a house that's in foreclosure or something like that, that's not going to be assumable. It has to be in current paid up status. Now, credit scores are super important in the home process, regardless of whether or not you use a VA or a conventional loan. Okay. So the first thing I always advise everyone to do is know their credit score. Okay, if you are still active duty, your fleet and family service centers, the military family centers, all of the financial counselors have codes from FICO, Fair Isaac Corporation, and they can help pull a free FICO score for you. Okay, you can reach out to me. I have a code. I'm happy to help you. But know what your credit score is. Pull that, take a look, and see where you are. Okay, so let's say, from this example here, you're sitting at 680. Well, I might say, you know, do you really need to buy now? And if the question is, well, I'd like to because this great house down the street just came on the market and I want to stay in my neighborhood, but I don't have to, right? I'm good. I got a house. We don't have to move. Then I would probably say, well, why don't you wait a little bit and see if you can work on your score? All right. Because if you can get that score up, to 780, that's going to reduce the interest rate that you will pay, right? Because the interest rate you get is based on your credit score. And you think it's only 1.5%. but look at the difference in that monthly payment between the 7% interest rate and a 1.5%. Okay, so everything's the same, right? There's that example of the property tax, the homeowner's insurance being collected, that principal and interest. That's where the difference is though, right? Because the interest at 7% is gonna add more to it than at 5.5, all right? So that's an extra $500 a month, but it's probably $100,000 over the course of that loan. Okay, so really important to consider the role that your credit score plays in the home buying process and the timing of when you're going to purchase something. So give yourself some time to work on your credit score, if it's not as high as you want it to be. Because again, you might qualify for a VA loan with a lower credit score, but it could be at a higher interest rate. Okay, so just kind of keep that in mind. Now, finally, I just want to say beware of copycat sites when you are out there getting your information. Okay. If you Google VA funding fee, the first thing that will probably come up is Veterans United. Okay. Um, some people have used Veterans United, but it is not an official VA website. So, what you want to look for when you're researching your benefits, when you're trying to get the official rates, the official information on VA home loans, is look for that .gov. VA.gov. That's how you know that you are at a reputable site where you can get the accurate information. And I encourage you to check there frequently. Policies change. Everything I'm telling you is current as of today, but who knows when Congress is in session, what kind of laws get passed when things change. So do your due diligence and check. These are not official sites, but all of these things come up when I type in VA home loans. So just be careful where you're getting your information. So, I appreciate you taking your lunch hour to join us today for our home buying seminar. Hope you learned some great things, had some good sources of information. Our team is always available to answer questions for our Navy Mutual members and any service members, veterans, and their families. So that is part of our mission to provide you benefit education. So if anybody has any questions after today, please feel free to reach out. I would love to talk to you. We will be doing an additional live webinar on the thrift savings plan in January. Been lots of updates with that. So if you have a TSP account and you kind of want to know what to do with this new mutual fund window or what to do when you transition from service or when you are finally 59 and a half and can make those withdrawals, stay tuned. We will be covering that in January. So I will pause for a second to see if there are any questions in the chat. And if not, again, I thank you for being with us today. And please reach out to our Navy Mutual Education Veteran Services team if there's anything we can assist you with regards to your personal financial education.